People that are looking for the fixer-uppers, and it's perfect for them. But I would say they are not the majority of renovation loans that I've ever seen done. The majority are, I found a house that's perfect for me and it doesn't meet my needs.
Hey, and welcome back. Thanks so much for watching. Today we have a special guest with us, Greg Campbell from MiMutual Mortgage. He is the director of wholesale side mortgages, and he has 20 years of experience on the lending side. And today we're going to be tackling renovation loans. We understand the importance of being able to buy a home and be able to make repairs, or maybe you are staying in a home and looking to update that. So renovation loans have lots of unknowns and maybe some hiccups along the way. So we're going to dive deep into it today to give you a nice highlight and then give you some real nitty gritties, I think, on the back end of it. So, and hopefully stick around for tips that Greg is going to be able to give you. So thanks so much, Greg, for joining us.
Hello, thanks for having me today.
Yeah, awesome. So I think today, like one of the things that, like obviously when I think renovation loans, I think fixer upper, right? Like, is that like the typical person you're dealing with? Like they're looking to buy a home and or sometimes maybe they don't even know that they're going to need a renovation loan.
It comes into play as an afterthought for most people. It's, I'm looking to buy a home. Most people in America don't go, hey, I want to go out and find a house that needs a new roof. You just don't think that way typically. Or I want to find a house that the furnace is about to die. So
Yeah.
renovation lending typically comes into play when you already have a motivated buyer that's looking to buy a house, but they just can't find the house that meets all their needs. So there's a lot of television shows out there about, hey, here's my dream house, and you get this big list from a customer. It's got to have this many bedrooms and this many bathrooms and this perfect type of kitchen, and I want hardwood floors and not carpeting. But there's no houses in their marketplace that check all the boxes. Well,
Mhm.
renovation lending allows you, it may not even be a house that needs to be a fixer upper, it just doesn't check all the boxes. They need an extra bathroom, or they need something updated in the house to meet their needs. It typically is what I call the save you loan of keeping things on track and keeping that purchase going forward. Sometimes you find the people that are looking for the fixer uppers, and it's perfect for them. But I would say they are not the majority of renovation loans that I've ever seen done. The majority are, I found a house that's perfect for me and it doesn't meet my needs, or it failed an inspection or an appraisal that says, there's something wrong with the property, where typically in the past, you just say, go fish and find a new house. Well, this allows you to correct the problem with the housing that you found. So I always say it's the collateral saving loan.
Yeah, no, that's great. I think, having the knowledge and, if we're talking to other realtors or people out there looking for homes, like having the knowledge that you do have the option to do a renovation loan on a home that you found that is otherwise perfect, like location wise or yard size wise, but maybe it needs, it needs the new roof or it needs the new floors updated and or you want to update the kitchen. Doing that, or the problems you found during the inspection, doing those things is great. The other day we were out showing a client a home down in central Houston, and it was built in 1967, and it was original to the core. And it even had like a record player built into the wall, right? Like that's how old it was.
Nice.
Yeah, I mean, I've never seen that before. I've never seen a record like literally you just pulled it down, like, hey, there it is. You can start playing your records, set the music. But I was talking to them about, hey, this would be a great house to probably do a renovation loan. They liked some of it and they were going to keep some of it, but like, updating the kitchen and the floors and take down a wall. I was like, hey, you guys need to be getting qualified probably for the renovation loan side of it. So you can make some of those improvements along the way, especially when you certain ages in neighborhoods that you might want to, that might be your dream neighborhood and it's got the great school district, but that home isn't updated like the rest of them on the block. Somebody hasn't already come in and fixed it or flipped it. And maybe that's could be a great thing. Now there's like two big different types of renovation loans that we offer at MyMutual.
I'd like to say there's kind of a chain of events you can do for renovation lending. FHA is the old one, the 203K you just referenced, and that comes in two varieties. There is a limited and a standard version to the 203K. The limited version is truly where they say it's limited repairs. That's where I'm not changing the structural composition of the property. And believe it or not, in just a matter of a week and a half, that product gets updated dramatically. It goes from 35,000 repairs to 75,000 repairs. So that limited is, I'm not adding additions, moving walls, or trying to have the open home concept. I am correcting what is, not making it something new. Then you have the standard 203K. That's the big one. That's where it's easier to say what you can't do to a property than what you can do to a property. So it's pretty amazing and dramatic. I can't buy a house and move it to a location. I can't buy a house, pick it up off the foundation, remove the foundation, and put a new one in. So you got to have a solid foundation to the home. But you can add additions, add second floors, add outbuildings, fix outbuildings. The sky's kind of the limit, and the limit is the value on the property compared to the properties around you. So the biggest thing you typically get in any renovation lending and value is by changing the quality and condition of the home. So it can be compared to other homes in that quality and condition, or also changing the footprint by adding bedrooms and bathrooms or square footage. Those are where you get the biggest bang for your buck. And then on the other side, conventional has renovation lending too. So Fannie Mae and Freddie Mac kind of came out and tried to mirror what FHA was doing. So they have conventional renovation lending that's very similar to FHA's standard 203K. And you can even go further on the conventional side, especially in Texas. You can finance new pools in the backyard. You could put in pools, hot tubs, redo the entire backyard and landscape of the property. Again, you could fix outbuildings. It's easier to say what you can't do than what you can. Again, I can't mess with picking up a house, raising a house, and building it from brand new, because that's technically construction lending and not renovation lending. But the sky's kind of the limit on what repairs can be made. FHA's got some very old school traps to it. And they say, oh, it can't be deemed a luxury item. So you can't put in a sauna, a spa, a whirlpool, a dumbwaiter. But the granite countertops are fine. The travertine tiles are fine. The heated floors are fine. So it's very kind of archaic on some of the things they limit you on and consider a luxury item. FHA allows you to repair a pool, but not create one. And those are some of the real differences between the products. But for the standard things people are looking for, like I want a new bathroom, new kitchen, I want to redo the layout of the property, I want to get rid of a wall between a dining room and a living room and make it an open room concept. All of those things are possible with these products.
So yeah, that's a great list of things you could do and not do. I guess I'll just have two follow-up questions for that. So like the conventional seems like it has more flexibility on a lot of things. And so that maybe gives you more options than maybe the 203K loan side of it. But also, isn't there, I guess my follow-up would that be with like the FHA side, we're going to be limited by there's going to be a lower loan limit as well, right?
Correct. FHA, you're capped by your county loan limit. So let's do a structured loan. Let's play pretend.
Sure.
So I'm buying a house for $200,000 and I want to make $100,000 in repairs. Well, that's going to work anywhere in the country with FHA or conventional.
Yeah.
And your FHA county loan limits is definitely a barrier on the amount you can lend. So a lot of people get this wrong when it comes to renovation lending. I'm not concerned about just the purchase price. So it's the purchase price plus the cost of repairs. As long as it makes the value, whichever's less is your 100% loan to value. So the best way to say it is this way. I'm buying it for $200,000. I'm doing $100,000 in repairs and the value comes back at $330,000. Well, if it comes back at $330,000, I'm doing my loan based off of $300,000. Mm-hmm. So it's the same as if I'm buying a house for $300,000 and the appraisal comes back at $330,000. My LTV is based off my purchase price, not the value of the property. So you just got to think it's very similar to that.
Yeah.
And that's conventional and FHA both roll like that when it comes to purchases on renovation lending. So that you get to have that is if I have $200,000 for my purchase price and $100,000 my total escrow holdback for my renovation lending on FHA, it's 96.5% of that dollar amount is now my base loan amount. On the conventional side, it runs the exact same way. It is your purchase price plus your repairs. Now, I always say there's traps between the two. There's benefits and drawbacks on both sides. The drawback on FHA is your county loan limit. The benefit is it's FHA lending and it has higher ratio capabilities. So you can have those higher ratios on the back end and the front end and still be able to do the loan. On the conventional side, yes, it has more capabilities of what repairs can be made to the property, but you're still dealing with mortgage insurance, well, the private mortgage insurance side, if you're above those LTV factors. And the other part of conventional that sometimes doesn't make as much sense is sometimes you'll see where the payment and rate make better sense on FHA right now in some days on the market than a conventional loan would. So there's pros and cons to both, and you have to kind of go down that checklist of pros and cons to find which one of those products is perfect for the borrower in front of you and the property in front of you.
Yeah, that makes sense. Obviously, for every property, we're going to kind of say, hey, what makes the best sense for this property and the repairs we're looking to do. If we're buying it, kind of close those county loan limits in Texas, I believe they're just under 500,000, like 498 or something like that. And so like if we're buying a $500,000 property, obviously we'll probably have to be going conventional anyways versus
Correct.
FHA. But if we're in the lower price range, then it makes sense that we can look at that as an option as well. Energy related improvements to the property on the conventional side as well too.
Well, when you start talking about energy efficiency, the biggest energy related efficiencies that people get is the furnaces, things that have electrical usage in a property. So if you're changing hot water heaters, furnaces, absolutely, you can change all the appliances in the property and finance the appliances as well. So typically your highest energy efficiency is appliance insulation too. You can re-insulate the property. You can do the foam insulation. You can re-insulate attics. So insulation and appliances are a big part of it. And absolutely, those can be financed and as part of the renovations.
So you did talk a little bit about like how much you could borrow, but so like 96.5% for FHA and conventional is it 95% is what
It's
we're kind
90,
of looking.
it is 95, and you can get an exception for that 97% if someone also meets that home possible as well.
So if
So
like a first time home buyer and they've taken
correct.
the
Correct.
classes and
Yeah. So they're stackable. I can have an FHA 203K HUD $100 down. So we're literally you're putting $100 down and it's an FHA 203K. They stack onto each other. And I know some people are going to say, "What was that?" And I'm sure you can explain it to them.
yeah. Yeah.
But the conventional side is the same way. So when you're thinking about renovation lending, it's still at its core a 203K is a core FHA loan. So you still got to follow all your FHA guidance. It's still just an FHA loan.
Sure.
Home style renovation is still just a Fannie Mae loan. So it has to still follow all of Fannie Mae's guidance for just a regular Fannie Mae purchase.
I didn't get too far off on it, but sometimes it helps. Like if you're already watching the video and like, hey, let's get the answer here. Can we go over? I mean, what about requirements for like credit wise? Let's just maybe touch on that for a minute. Is there a big difference between the two types of loans, or we just always like need to be, are they just going to follow the guidelines again, or how does that go?
Again, you're following straight guidelines. So when it comes to FHA, it's FHA guidelines. If they qualify for an FHA loan, they're going to qualify for the 203Ks. With conventional, you're running your findings. And if the findings accept a loan, you're within the ratio tolerance. There's no additional credit requirement on top of these programs that's stacked on top of the traditional requirements you'd already have to have.
Yeah. So like with FHA, we're going to be 580 and above, and conventional, we're usually looking about 620 and above to, and then obviously the higher your credit score, usually the better your rate could be for those things.
Yeah, that's more of a function of pricing, and it has little to nothing to do with renovation itself.
Now we've talked a lot about what we could do and not do. I think this is a great benefit to be able to like purchase a property, finance some of the repairs into the loan, and then you get this 30-year fixed low interest rate loan that repairs are done now. But what is the addition? Is there any additional cost to do these loans other than just the origination and the typical title stuff and all the other things?
Fee consultants might have to be involved. So a fee consultant is a third party, and on an FHA loan, it's a HUD accepted fee consultant. And we use fee consultants too sometimes on the conventional side. And a fee consultant is like what I call the referee in the whole renovation process. They're reviewing the contractor's bids. They go out to the property and do inspections when contractors want draws after close. So the fee consultant has an upfront write-up cost for when they do a write-up for the loan. And then they have draw costs to come out to the property and issue draws to the contractor. Other costs you might have up front is permit cost, where you might have to have additional permits, and that can be financed as well. All of these things can be financed. The fee consultant can be financed as well, and his draws can be financed. The other thing is you might have to have architectural and engineering exhibits. So if I'm adding an addition to the property, that has to be done by an architect. If I'm removing load-bearing walls in a property, I have to have an engineer tell me how to carry the load. And again, those items can be financed as part of the loan as well. So it's pretty robust in that. But yes, those fees are added to it, but all those fees are associated to the construction process of the loan. There is not additional fees added to the loan itself, just the professionals needed for the construction to be completed.
So that's pretty amazing right there. Like obviously there's costs of making sure you're doing it right, getting the permits. The consultant fee who's going to help out with doing the process between the lender and the contractor, and then so you can roll those costs into the loan, so it's not like an extra burden you got to just come out of pocket necessarily with. And obviously, some of this money is held back in reserves. I think we usually 10% reserve, right?
It can be 10 to 15% on conventional, and 10 to 20% on FHA. FHA has a grid that gives you a standard of how much reserves have to be. And if you're using a fee consultant, he's the one that dictates that amount. So if the fee consultant goes out to the property and says, this is the age of the property and the scope of work, we need 15%, that's the amount we have to hold back. On the conventional side, we really look at the scope of work being done. If we're dealing with investment properties with multi-units, we typically will hold more money back for those, because you might be fixing one thing in one unit, and when you open it up, it cascades. But 10% is definitely the minimum. And if the money's not used, it's applied as a principal reduction at the end of the loan. The money cannot be rebated back to the customer, because these are considered purchases, or on the refinance side, rate and term refinances. So no money can actually go to the borrower's pockets in either case.
Well, that's awesome. So I'll have two questions following up that. What's first is, how much is a typical fee consultant, like how much is their fee? And does that vary across the country, or is that just kind of like, what does that fee look like?
Their fee can be anywhere from $800 to $1,500 for the initial write-up, depending on the scope of work. So HUD has that broken down. So it's all dependent on how much construction is being done. Their fee then can slide up and down a scale depending on the work being completed. The typical cost is around $1,000 for the initial write-up. That's the typical cost I see.
Okay, now, and that doesn't seem like that much like of a fee, considering if you're going to be borrowing maybe $20,000-$30,000, right?
Or if not hundreds of thousands of dollars in renovation lending.
Exactly.
And then their reinspection charge can change too, depending on how far away from the project they are. So a reinspection fee on an FHA loan can be anywhere from $150 per reinspection to $350 per reinspection. And on the conventional side, it can be as high as $200 per reinspection. So there is varying fees on it. The maximum I've ever seen is right around $3,000 in fees for that fee consultant. But we were talking about a job I did that had $300,000 in construction renovation.
Kind of monitored and said they're not just like, oh, the fee consultant is going to be $10,000, just because I want it to be, right? So it's kind of based on the job and how many draws and inspections we're going to be doing along the way. So let me ask you about like the appraisal process, because a lot of times, like, just because we're buying that $300,000 home and we're putting $50,000 into it, and we assume it's going to be okay, well, we added $50,000 worth of repairs or to it, so it should be worth $350, right? No problem.
I would love to say that, but that's not the case.
Yeah, I understand it's not, because I understand you don't always see the value add. So just maybe give me a highlights for the appraisal. The appraisal process are going to exactly the same as usual, right? If we're just doing purchase.
No, not. It's a little bit different. So on the FHA side and on the conventional side, on both sides, I need the contractor's bids fully written up and broken down, because the appraiser now has to pretend this property's done. So they're giving me their impression of the value with all the work completed, not how the property stands today. And so that's the big gray area right there. So if the better the bid I get from the contractor, the better of an understanding the appraiser has of what's being done to the property, the better they can appraise the property in the area. You can overdo a property and ask for over improvements to your marketplace. So if I'm in a marketplace of all 1,700 square foot homes of around you, or a development of 1,700 square foot homes, and now you want to make a 4,500 square foot home, it's not going to work. You're not going to get the value. You've over improved your property. I know that's taking it to the ridiculous, but it does happen sometimes.
No, we literally have it right now. We have a listing right now where the every average home size is like 2,400 square foot and it's 4,000 square feet. And it's like, you did too much to it. You're not going to see that value back on
You're
it.
not going to see that value back. In the state of Michigan, where I am, because I've seen the most, is we have a lot of basements up north. And a lot of people like to make the basements like the rest of the house. And they'll put bedrooms and bathrooms and living rooms and theaters in their basement. And it's all below grade. And below grade does not count the same as above grade. So you can put $200,000 in your basement and get 50,000 in value. That's it. Yeah. So during the time when I'm putting these together, I look at the purchase price and I look at the repairs, and you have to start somewhere to structure your loan and to have an idea. And you add those two together and say, if value comes in, I should be okay. Now, this is where, again, FHA and conventional can differ. FHA says as long as it's not a condo, I can do 110% of that after improved value, because HUD knows not every repair equals value, but they give you a leeway. So an example of that would be, I'm buying a house for $200,000. I'm putting $75,000 in total repairs on the property, and the value comes back at $250,000. Your gut would say, well, this game's over. Well, what is 110% of $250,000? Oh, I'm still at $275,000. I'm fine. The deal still works. Conventional doesn't give you that leeway. Conventional is you have to have the value of those two pieces put together to make it. If I'm buying it for $200,000, putting in $75,000, if I want maximum financing, it's got to be worth at least $275,000 at the end of the day. So that's where sometimes FHA, again, the benefits and the pros and cons of each product might be the right product, because appliances, carpet, paint, stuff like that, they don't give you new value. Appraisers will believe the carpet will need to be replaced, and you're going to take your brand new appliances with you when you leave the house. So those things don't give you value into a property. The biggest bang for your buck, and truly this is where the most value comes from in any renovation lending, is changing the quality and the condition of the property. It's truly taking that quality and condition of never been updated to being updated, that they can compare it to updated properties. And you've seen this if you've been in the business long enough, that a house will come in and get dinged and scored way down because, the kitchen's from the 60s. The flooring and walls have never been replaced. I can't compare it to the new house down the street. Oh, I'm completely gutting and renovating this house. I can almost compare it to new construction, because I'm taking that quality and the condition up. And again, footprint makes a big difference. So if I'm buying a house where someone demolished it to make it a 1-bedroom, and I'm turning it back into a 3-bedroom, by changing the bedroom count, I can now change what comparables I'm looking at that house with. So it makes a massive difference on what repairs you're making. The biggest things like new roofs, that's huge on a house. That's value right away, because that is a condition and a quality aspect of a property. New insulation is a quality and condition aspect of a property. So that's where the gray comes in. And it's just like any purchase. Nobody knows what the appraiser is going to come back with in value, except for that appraiser. And I've had 3 appraisers appraise the same property and get 3 different values. So again, it's something that it's like any purchase or any refinance. You still have to get an appraisal, and you still have to have the value in the property to make it work.
No, that's great. I mean, you just shared a lot of great information there, and I really appreciate that, because I think that's one of the big things that's kind of scary too, when we're doing the renovation is, are we adding value in the right areas, and are we doing what the appraiser is going to actually see? And you gave a lot of great tips there about, room and square footage and actually bringing it up to date to the rest of the properties and comparables, because that's really what we value single family residents as, is comparables that have sold right in the last, year to say, hey, like, does this compare to those two? That's how we're appraising those properties and establishing the value, right? So that's really good information. And that was one of the things that, like, when I was bought my properties too, I would take in a property that was subpar, that didn't have anything, and I'd be putting the brand new stuff in the kitchen, the upgraded floors and countertops and bathrooms and kitchens, right? And then that would then drive the value up. So that was, what the appraisers wanted to see too. Real estate myself was starting as an investor. Is it kind of the typical, if we wanted to do the conventional, we could do 75% of the after, repaired value, or the as is completed value, or what does that look like on a single family residence?
You have it just right. Your LTV factors on a conventional loan don't change because it's a renovation loan. Here is some of the traps on it is Fannie Mae doesn't allow for multi-unit investment property rehabilitation. Freddie's product does. That's one big difference between two different conventional products. So the Freddie one is called Freddie Choice, and Fannie Mae is the home style renovation. So if it's a 3-unit, you just can't go home style renovation. It's out. You cannot do manufactured investment properties. That's out. So if it's a manufactured home, you're not doing a renovation loan, especially on the investor side. It's just out of the equation. Fannie Mae and Freddie Mac have different ways of approaching properties that have ADUs and rental income from the ADU. Fannie Mae doesn't allow you to use the rental income from the ADU to help qualify, where Freddie Mac does. So I know ADUs are probably a bigger topic in California, but I think they're a growing topic in parts of Texas as well. So those are the nuances you would get from just the products themselves if you weren't even renovating the property to begin with. So it follows standard Fannie, standard Freddie guidance. Here's the big trap. It is not a flip transaction. It is not for property flippers. This isn't a loan for, I want to buy that house, finance the repairs, and sell it. It is meant for people that want to buy the house, finance the repairs, and rent it.
This type of product would be good for if I'm going to live in it, or I already live in it, or
Correct.
I'm going to buy it and then fix it up and then rent it back out, right?
Correct.
So those are kind of the main three. So I started, and I used actually hard money, which we won't get too deep into, but basically I used hard money, and then I would refinance into a 30-year fixed mortgage after that to rent it out, right? And so I'm having 2 closes over here, and I'm borrowing money for the repairs too. So I had double the cost in a lot of ways of just doing the single close.
Well, the hard money lending too, the interest you're paying back a lot of times, or the fees they want back on a hard money loan, are drastically different than a conventional loan. And the fact that you have to go back and hope you have the value now to refinance it conventionally is a trap too. Because you use the hard money to over improve it. This takes away a lot of those traps and having that one-time close.
Yeah, no, that's awesome. And then obviously, like I say, the hard money on 10, 11, 12% interest rate. And obviously I was moving quickly. We were getting out of these quickly. But the idea was that, like, if anything slowed you down, if you had a bigger renovation and it took longer than you thought, then you could be stuck in this loan a lot longer at the higher interest rate. So definitely.
There's one thing I wanted to mention too that makes this different. When you're doing those hard money loans, you're making the payments immediately. Renovation lending allows you to finance with us your first 6 months of payments too. So you're not making a payment during the renovation process. So that's
amazing.
If you're doing a massive renovation on the property and you have to have dual housing, I am gutting this property. There's going to be no kitchens and no bathrooms to have. Well, if you have to make the payment on that property and make the payment for a rental during that time period, I have to consider that rental as part of your ratios for financing ability. And that can drop a lot of people from the ability to finance that. By adding in those mortgage payments in the financing, it a lot of times saves that borrower from having to make the payments while the repairs are being made.
And we can do that up to 6 months, right?
Correct.
And so typically, though, most people aren't, do they kind of, you have to plan that kind of out ahead, like talking with the fee consultant, like, hey, we think this is going to take 3 or 4 months or whatever, right? Or,
well, this is the fun part of it all too. So on the conventional side, the contractors have to give you a time frame of work being completed. On the FHA side, they're not going to give you that time frame, but you're working between the fee consultants and the contractors and trying to build a time frame. And each one of these has different rules on how fast the work has to be completed. But typically, both of them have up to a year before we start having real problems. Most projects do get completed in 3 to 6 months. I would say probably 80 to 90% of the projects. But I can tell you, I've had everything go wrong. I've had contractors quit. I've had contractors pass away on the job. I've had houses catch on fire afterwards, and you're already in the middle of a construction process. So the unintended part of life is always there, but you definitely want to try to drill it down with your contractors in the beginning of finding a really great contractor that can give you estimated timeframes that you can hold them to, and always know even the best one is going to tell you it's going to get done faster than it ever will.
Mm-hmm. Always leave a little fluff in there for,
yeah, always.
If you're still sticking around, and you poured out a lot of great information, but if you have any other tips.
I got two big ones for you. The first one is, if you need more than one specific contractor to get the job, if more than two, get one. So if I just need windows and a new roof, and there's a company that specializes in windows and a roofing company, great. You can use two contractors. The minute I need a third contractor, you go to a general contractor and get one and deal with one person. Trying to get multiple contractors on the job site in that time frame to get things completed and them paid will turn into a full-time nightmare after close. So I always refer to renovation lending to the majority of the world as either the nightmare loan or Bigfoot. The nightmare loan being you've tried one, you've been a party to one, and it was a nightmare. You did a ton of paperwork and things went sideways. But if you're not working with someone that has an idea to set the right expectations and knows how the process and the paperwork works well, welcome to your nightmare. You're going to do paperwork all over again. And another one is setting clear expectations to all parties involved. So the clear expectations, if I'm a borrower, is I need a home for a renovation loan to exist. I've had only one person in my home career that says, I think I want to buy a house that needs to be fixed up. And I go, great. What am I pretending you're doing? A roof? I don't know what that means. Qualify for what you can qualify for, and that's what you can qualify for. And if you find a house under that amount and you want to make repairs to it, there you are. Have a clear idea of what you want to have done to the property before you do anything. It's not, I think I'd like this, or maybe this is what will change. No, there's no maybes or I thinks. You define what you want to have done to that property. It has to be defined. So I've always worked with homeowners and said, have a piece of paper split out. I have to get rid of the mold. I have to have a new roof. I have to fix the rotten floor in the bathroom. These are things I have to do to make the house financeable. Those are non-negotiables. You would like to get rid of the pink bathroom from the 80s. You would like to have new carpet, paint, and appliances. Those are wishes, because your appliances might have an idea that I want the Sub-Zero freezer, but the value might say you're not getting a Sub-Zero freezer. You're getting a GE freezer or whatever those might be. By having a clear expectation of what you want to have done to the property is probably the most important part. You do not want to leave these repairs up in the air of maybe I want this or maybe I don't want that. The next one is, once you vet that contractor and find a great contractor, if you as the loan officer have now ordered the appraisal and you're close to closing and I want to change my contractor, this loan is now starting from day one. The clock is over and we start over again to the beginning of the clock. I had a customer once, and this is just a real life story, went to a home and garden show 2 days before close and said, I found a new contractor. This is the guy. Let's close in 2 days, but this guy's doing the work. Nope, doesn't work that way. I have to have all new paperwork done on all the new contractor, vet the new contractor, make sure he's licensed appropriately, has the right insurance, fills out all the qualifications, gives me the bid. I got to send that bid back to the appraiser, hope the value doesn't change when the appraiser changes the bids to be the right contractor into it, all to find out that the contractor they picked at the home and garden show was under a lawsuit for work they didn't do well on the last property they did. And so you're starting all over again. So I call that welcome to your nightmare. So have the right expectations with all parties involved. There is an extended time period in the beginning to get these set up. Typically, they don't happen as fast as a regular purchase because of the contractor. Anytime you're adding contractors and fee consultant, you're adding a complexity to the loan of other human beings that you cannot control completely.
Mm-hmm.
So give yourself more time. They're an awesome product. We can help you along the way, is my best advice to it. And truly, truly understand what you want to have done to the property before you start getting contractors involved.
Really great tips, because I going back to me, like, you want to know what you're buying, kind of like what you're going to be doing to it, who's going to do the work, what have that expectation of like how can they get the job done, or they're busy with six other jobs and they're not going to get to you, and like are they communicative? Can you actually get a itemized quote from them, right? All those ideas of knowing and being prepared before you start the process is going to, all that free work is going to help you make this a much smoother process, because it doesn't have to be a nightmare, right? It can go smoothly.
Correct.
There will be, always allow for hiccups and allow for delays and overruns or changes, because nothing ever goes as planned, right? But the idea is, like, if you do a bunch of the legwork ahead of time, you get pre-qualified first, you kind of know what you want to do to the property, and you got all those people lined up, it's going to make it a much smoother process, and you won't be pulling your hair out along the way as much anyways.
You hope. That's the hope.
Well, down below, we'll have a link for you if you are interested in applying for a renovation loan, or you just a regular loan and then might turn into a renovation loan you're thinking. So obviously I'll have that down below. We'll have some other cool tools on our website. I'll link to them below. And as always, I thank you so much, Greg, for joining us. And as always, we're here to
Thank
bring you
you.
real life experience to all your real estate needs.